Hello and welcome, and I'm your host, Konstantin Kogan, and we're here at Holistic Investments, and I'm excited to have another guest today, Haseeb Qureshi, is one of the founding partners and managing partner in Dragonfly Capital. Hi, Haseeb.
Hey, Konstantin. Thanks for having me.
So really good to have you here. So I've been watching your posts on LinkedIn and different presentations. I know you've been an instructor, you've been a poker player. We're going to talk about it. And how did you transition from this career of yours to analyzing blockchain and different companies, investing and being a successful entrepreneur as well. So there are a lot of things to cover and also fundamental problems. But before we jump into the weeds, I want to also traditionally announce the disclaimer that this content is for informational purposes only, and you should not construe any such information or any other material as legal, tax, investment, financial, or any other advice. So now we can talk about almost anything, right? Because this is not an advice.
Perfect.
So yeah, I've looked at your interesting career path, right? You were still almost like a teenager, and you started to dab into poker, right? And you were pretty good at it, right? I've seen you've been wrote books, you've been doing courses. So maybe talk a little bit what was the transition? When did you first discover crypto for you?
So I discovered crypto. It was actually quite a while after I was a poker player. So I played poker professionally from when I was 16 years old until I was 21. Then I went back to school. Then I ended up getting into the tech industry. And I was actually a software engineer at Airbnb when I first got into crypto. Mm-hmm. I'd known about crypto for a while before that. And I remember having used Bitcoin a couple times to buy some modafinil online or something. But then it always seemed like this kind of curiosity. I didn't really see what the big deal was with Bitcoin until the time that I was at Airbnb, because it was there that I started spending a lot of time working on payments. So at Airbnb, I was working on the payments fraud team as a software engineer. And Airbnb is a company that pays people all around the world, in 60 plus countries around the world. And because you're a travel company, you need to have a fluid way to be able to pay people in every single country. So you need to abstract over this global payment system. And in reality, there is no global payment system. There's a bunch of balkanized little payment systems in different countries, none of which speak to each other very elegantly, and all of which were built 50 years ago. So they're all very, very antiquated. They have, they don't have common data standards. There are some places where you have to manually email CSVs at midnight that get manually reconciled by human beings, because these things were just not built for the world we live in today.
Yeah.
They were not built for a digital first global real-time system like de facto what Airbnb actually is. Mm-hmm. And seeing this as an engineer for the first time and really understanding how utterly ill-suited the payment systems we have in the world are today for the world that we actually live in, as an engineer, your first instinct when you see a system that's that broken is, oh, we should throw this away and we should start over. And I realized that that's what crypto was. Mm-hmm. Crypto was a bunch of engineers and philosophers and computer scientists and economists and game theorists who got together and said, knowing what we know today about how technology works and how payments works and everything we know about peer-to-peer systems and cryptography and blah, 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 how would you redesign a payment system today? And one answer to that question was Bitcoin. Another answer was Ethereum. And another answer, going down the list. These were all different answers to that question. And when I realized that, I thought there is no way that this is not going to affect the future of how money is done. And that's what convinced me to go full-time into crypto.
And then, so that was about 2016, 17, right? And then you were also an engineer in earn.com. Actually, ironically, I was one of the early users of earn.com, but that's...
Is that right?
Yeah. I mean, I remember, I think it was a beautiful idea, but let's put it this way, something did not work out, right?
Yes. So yeah, 21 became, it rebranded to earn.com and eventually got acquired by Coinbase. Yeah. And it was basically the brainchild of Balaji Srinivasan, who's, he used to be after 21 got acquired, he went to Coinbase and was CTO at Coinbase. And then now he's moved on and is doing his own thing called 1729. But that company, it's funny, that company had been through so many, it had been through so many ups and downs over its time. It was really through sheer force of will of just one man, who was Balaji, keeping that company together and keeping it alive, and single-handedly closing almost all the sales that made that company successful. So that was a real experience. But it was also an education in
For sure.
what was the universal possibility within crypto, different kinds of applications that could work.
No, I mean, I love the product. I just realized at some point, there was a problem of growth and there was a problem of adoption, and people understanding what's the next feature they can also use besides just like messaging and paying like a Bitcoin or getting paid to Bitcoin for a fraction of Bitcoin for getting message. Otherwise, I think it was still like it would be a great addition to any maybe a different product. That's why I think Coinbase also was interested in it. But then you were also a junk instructor, right? And you have several courses that you created, teaching like blockchain and the basics of, the DLT technology. So maybe you can talk about a little bit like where people can find it, maybe if it's still relevant.
Yeah. So I was teaching a course at this place called the Bradfield School of Computer Science in San Francisco, and this was what was it? This is 2017, 2018. I was teaching a course in person. Actually, funny enough, one of the very first cohort, one of the students in that course went on to be the founder of FutureSwap. I don't know if you're familiar with FutureSwap, but he actually learned crypto from my course and then went on to co-create, one of the DeFi perpetual protocols that exists on Ethereum today. But so it was a great course, and eventually I decided that I wanted to open source it and create it in a format that could be digestible for anybody. And so I started putting it together online and launched it on Nakamoto.com. So if you go to Nakamoto.com today, you actually see the course. Unfortunately, it's not finished because I ended up joining Dragonfly in the middle of working on this course. And naturally, and I think you're probably familiar with this yourself, investing, especially in a space that's as fast moving as this one, unfortunately, it just chews through your free time in a way that's very difficult to ever recover. So unfortunately, the course is not done. I think there are only 3 of the planned 8 modules are actually finished, but as a very, very gentle introduction to the beginning parts of crypto for the technical person, I think it can be still fairly useful.
And by the way, how did you learn to code? Because I've seen that's not your primary education, right? So that you learned it later.
Yes. So I actually studied nothing technical in school. So I studied philosophy and English when I was in university, which of course is basically useless in any kind of STEM field. So I essentially had to. What happened was I ended up moving out. I used to live in Texas. I came out to San Francisco to go take a coding bootcamp and learn how to code. The coding bootcamp was called App Academy, based in San Francisco, which is one of the highest ranked coding bootcamps in the US. I went out there, learned how to code. It's a 3-month program. At the end of 2 months, they asked me to come on board as an instructor to help teach the course. And then a couple months after I became an instructor, they asked me to become director of product for the entire school. And so I did that for about a year before moving on and going into a more traditional software engineering role. But the short answer of how I learned to code is, just doing it a lot. There's nothing, and this is just kind of the universal lesson from almost everything that I've done. The best way to get good at something is just to spend a lot of fucking time doing it. Period.
That's a quote, so I think.
Yeah, exactly.
Okay, so that's understandable. So, but it's impressive that you're also you understand that teaching this also helps you to learn it better as well, right? So, and then tell us, how did you get to how did you get to Dragonfly Capital? Did you meet the your co-founder, and then that's how you started it, or maybe you co-invested with someone? What was the inception story there?
Yeah, so I used to be at another fund called Metastable Capital, which is founded by Naval Ravikant, one of the very oldest crypto funds. And that's right. Bitbull was an investor into Metastable, and that was my first foray into the investing side. And so while I was a GP there, actually one of the investors into Metastable was Bo Fung, who's the other managing partner now at Dragonfly. He was an investor into Metastable, and he and I built up a relationship during that time. And essentially was after the bear market came through and things kind of slowed down a lot at all the big investment firms. I remember having a couple of long dinners with Bo, talking about his vision for Dragonfly and what a different kind of fund in crypto could look like. A fund that was actually truly global, the way that crypto is global. One that kind of spanned the world, saw everything that was going on, was not just mired in the perspective of Silicon Valley. And that seemed really new and really ambitious to me. Mm-hmm. And I decided to take a leap and to build this firm alongside Bo. And knock on wood, so far it's been pretty great.
I mean, yeah. If somebody doesn't know the portfolio of Dragonfly Capital, those are like some of the iconic companies already in crypto. Like I've seen when I just first checked your latest portfolio, like those are companies that some of them I use personally. Like 1inch I use like almost on a daily basis. Like there are great companies like Anchorage, Amber, like Cello, Coda, like and Coinflex, Compound, Cosmos, like DYDX. I mean, like half of the companies I either know or use myself, so and that is why it was impressive to me, because that means you have a pretty good due diligence mechanism, right? And I want to talk about what's your investment thesis and how do you even approach to due diligence companies, because you have to be pretty technical to, besides like your standard who are the founders, where they're incorporated, the financials, the basic common sense, that the market is there, but also technical side. You need to be are you outsourcing to the ability to even due diligence the smart contracts or any other technical side of it, or you do it in-house? So can you tell a bit more about this?
Yeah, so a big part of our DNA at Dragonfly, and this very much comes from, I think, my lineage at Metastable, a big part of our DNA is being very, very close to the technology. So we fundamentally believe that crypto is still in many ways in the basic science phase, where it requires a lot of technical expertise in order to be able to underwrite and diligence the stuff that people are building in the space. And at the end of the day, most of the money that you're going to make as an investor is by investing in innovation. And if you cannot understand the innovation, you probably can't underwrite it. So for us, most of the people on our team on the investing side are technical, meaning that they've had a computer science education or they've worked professionally as programmers the way that I have. And that allows you not only to actually look at the tech, read the contracts, understand the white paper, be able to delve into what people are building, not just understand what they're doing, but partner with them on it. And overwhelmingly, what you see from entrepreneurs in crypto is that they resonate much more with builders than they do with investors, quote unquote. I mean, you can kind of see that from the, I don't know if you were following any of the drama around the sushi swap sale that was going on, where, overwhelmingly the people who, again, really win the trust of people in the community are people who are, kind of nose to the ground, actually building things alongside the companies that they're getting involved with. And that's the ethos that we try to embody at Dragonfly. So, to answer your question in short, I think there will be a point where you can consider outsourcing your diligence. Like crypto will be so well understood and kind of boring and easy to understand and easy to underwrite. At some point we're going to get there, but we're definitely not there today. And I think it very much behooves an investor to be able to go deep into this technology and understand what a entrepreneur is doing, and ideally even help them in what they're trying to accomplish.
No, I actually have seen models where investors are actually doing like a double check. Like, for example, if it's a project from Tezos, and they frankly can admit that they don't know Tezos enough to even understand the innovation. So they would go to the core developers Tezos, or people who just somehow are connected and building on it, and order an analysis, like, an audit of the code. Okay, so that's I not necessarily I see a problem in that. Like, it just never, like, if they're really considered an investment, right? So but of course, if you have it in house, that's golden. That's perfect. I just don't know a lot of funds who actually are capable, like you are, like, of doing everything in house, right? Let's put it this way.
Right. I mean, look, doing everything in house is a tall order, right? So we also depend on the judgment of other people who we trust, and we have a lot of partners and friends in the community who they bring a deal to us and they say, hey, this thing is great, and I did it. That's going to mean a lot to us, seeing the signal from another investor who we trust. But at the end of the day, the thing that earns us a seat at the table is the fact that we bring a lot of value to the table beyond just money. And I think we're quickly getting to a space, and I'm sure you feel this as much as we do, quickly getting to the point where allocations back in the day, in 2017, 2018, you would get an allocation just for showing up and for saying yes. And, everybody was, it was very kumbaya. Everybody was ready to share, as long as you're on board and you see the vision, great, here's some allocation. It feels like those days are numbered, if not already over. And more and more, it's going to be incumbent on investors to earn their seat at the table whenever they want to bite. Yeah,
I agree. It's now a different market where smart money win the actual allocation, and you need to have connections, you need to have like partnerships, you need to be an active investor, right? And actually understand them and support them in so many ways. Otherwise, you're just not invited to the festival. That's very easy. I've seen a lot of like big investors being turned down just because either they're considered like just a logo on a deck, or they're just or just not. They don't fully understand or appreciate the technology, right? So I agree. It's a very different market, even though right now it's a little bit of a turn to bearish trend, but I'm sure like it's going to change. So other things I want to ask you. So how many companies, like we have a mandate, like, how many companies you're willing to invest during the year?
We don't have a particular mandate on a number of companies that we want to invest in a year, but I'd say, over the course of a fund, we probably invest in somewhere between 30 to 40 different companies over the lifetime of a fund, something like that.
Got it. 30%. So far, how many did you invest in?
That's a good question. This year or
well, generally, let's put it this way. How much left?
In this fund, I don't know. So again, we don't like sort of parcel out the number of names. It's more about, it's very opportunistic. So we see a great opportunity, whether it's seed or whether it's Series A or, even potentially later stages than that. And we're happy to write checks. In this fund, I would guess that we've written probably about 20, 20 names, some of which are public, some of which are not.
So basically it's about like half left for and you,
something like that.
And you're going into early stage, or like, as I can imagine, right? And then maybe even a little bit later. Sometimes are you going to Series A or later stages or not?
Yes, so we will definitely also do Series A's, and occasionally we'll do a Series B if we have high conviction on it. But we try to stay earlier stages because that's our bread and butter, and it's where our advantage most shines. Just also given our fund size, it's what makes sense.
For some of the entrepreneurs who are listening and they would want to pitch, to you, like, tell them what will be the best opportunity to, like, what do they need to be prepared to even approach you guys?
What do they need to be prepared? Depends on the stage. If you're a seed stage or pre-seed, then you may not need to have a whole lot prepared other than just a good idea and some conviction in order to get us excited about what you're doing.
Even
if it's a Series A, sorry?
Even testnet, you would not even require?
Oh, of course not. Of course not. If you're a seed stage and you already have a testnet, that's pretty impressive. I mean, it depends on what you're building, right? Like if you're building if you're forking Uniswap v3, then okay, probably you should have everything ready to go. But if you're going to be building something from scratch, especially if you're going to build something technologically complex, then no, not at all. I mean, very often we're funding things at the layer of just people, a team, and an idea. And here's some money to go. So it very much depends on where in the process they are and the stage of development of the project. If it's a Series A or a Series B, then certainly we want to see some financials, a deck, kind of the clear outline of the product or what the fund is going to be used for to build out. But in the earliest stages, a lot of people think that they need a deck. Deck is nice to have, but it's not strictly necessary depending on the stage. If you really just have an idea and you wanted to run it by us, we're always happy to chat with people working on interesting things.
Perfect. No, that's good to know. So I'm sure people will find, and then like on your website, I will share the links, so they just send an idea, like, a brief message, and you don't have like a particular form that they have to fill in.
No, you can just email us. We're at hello@bcp.capital.
It's that simple, guys. So that's
easy. It's that easy.
So good. So we covered, I think that will make some people excited. So we'll put a timestamp on this so that people will definitely find this moment. So let's talk about like some other like exciting things. So what's your vision? What's going to happen next to the industry? The next big thing. So there is a lot of promises in like late September, October, like, in the Ethereum community, there are a lot of like people who are in Cardano and Polkadot. And we hear a lot of like scalability opportunity stories. They solve, like the gas fees problem, a lot of those things. But at the same time, we see like we're being bleeded by the news that are coming out from China and from many other sources right now. The market, altcoins are not feeling great. So what would you say to maybe inspire people a little bit? Like, what is your prediction till the end of the year? Or maybe not.
People. I don't know. Yeah, I don't know if that's. I'm definitely not in the business of inspiring people. If I did, I'd be compensated very differently than I am. What would I say that to inspire people? I mean, so here's what I'd say is that I think a lot of crypto and a lot of DeFi, it's clear that at the beginning of the year, there was a lot of irrational exuberance about what's going on in crypto. And it's also pretty clear that valuations were getting ahead of themselves and ahead of fundamentals. That's okay. That's, we sort of expect that at this point, that crypto has a natural reflexiveness and volatility to it that is unlike almost any other asset class. That's normal. If you've been in crypto long enough, you come to expect that, that when a new generation of people find a new generation of technology that's built on top of blockchains, they're going to get excited about it. And then they're going to eventually realize, like, okay, what is and what is not ready yet? What is and is not possible yet? Part of, I think, what was, to me at the time, very clearly not sufficiently appreciated is the regulatory situation that underlies everything in crypto. And this is something I've been writing about for a long time, which is, the degree to which, for example, stablecoins are probably not in a stable equilibrium with respect to regulation. If you get to a world where anybody can transfer, $30 million in stablecoins to anybody else in the world in milliseconds, that's probably not going to be the case forever. Like, probably at some point something's going to happen and regulators going to prick their nose up and say, hey, what the hell? I don't like this. Let's let's find some way to fit what you guys are doing into our old regime. And, we saw that yesterday with the working group between, the Fed and some of the folks in Congress on stablecoins, that it looks like there's going to be some regulation coming down the pipe. Who knows what it is, but stablecoins are not likely to live in this total no man's land of basically unregulated private money. I think that's going to change. And
in the European Union, they do the same right now. They passed potentially a bill that will ban the anonymous crypto wallets.
I saw that.
That's
yes.
It's still like they're talking about it, but that's happening everywhere, I'm sure. So.
Yes, I mean it sounds very unlikely that regulation in the form that it's described is going to actually be passed, but something. But it's a sign. It's a sign of the sentiment that is fairly widespread of whenever crypto gets really big and the adoption kind of there's a frenzy of adoption all at once. Regulators get scared. Regulators in general are not fans of sudden change. They like very, very gradual and monitored change. And crypto is not a fan of that kind of change. Crypto is very much a fan of step change. So it's no surprise to me that after we saw these crazy run-ups in the price of everything and all these individuals and institutions and whatever getting into crypto adoption, that we were going to see a regulatory backlash. And we saw it. We saw it in China. We're seeing it now in the US with respect to some of the stuff with stablecoins. We haven't seen the SEC act yet, but we're seeing some stuff in the UK, seeing some stuff in the EU, as you mentioned. And it's likely going to be some equilibrium between, so regulated that it chokes these things off. I don't think that's going to happen. But also, it's not going to be basically, we're free to innovate in our own Wild West corner of the world and leave us alone. You have nothing to tell us. Neither of those two extremes are going to come true. There's going to be some middle path that we end up on. And I think a large part of the reason for much of the woes in the crypto prices and crypto sentiment is, for some reason, people didn't expect that. They thought that, great, prices go up and now it's just like up and to the right forever and no one's ever going to stop us. And there's a natural slinky effect of regulation. The more crazy things get, the more regulators are going to want to tamp it down. So I think this is to be expected. I don't want to prognosticate on where the market's going to be in 4 or 5 months, but I will pretty clearly stake out that there's going to be more regulation, and probably a lot of it is going to throw cold water on some of the things that some people are doing in crypto. But that's okay. Crypto is going to survive. The space is not going to go away. Institutions are going to stay in the space, but everything almost always is going to take longer than you think. So the one thing that I've learned from being in crypto long enough is that crypto happens faster than people outside of it think it's going to happen, and it happens slower than people inside the industry think it's going to happen.
Yeah, that's a good one. So what are the biggest trends are you looking at right now?
Biggest trends we're looking at. There are many. One big trend that we're paying a lot of attention to is the scaling of smart contracts and these new non-Ethereum based layer ones. So that includes Binance Smart Chain, Polygon, Terra, Avalanche, Near Protocol, Solana, Polkadot. There's a big race right now to kind of see what is going to be the future of Ethereum scaling. And of course, rollups are another aspect of that question, which are more verticalized based on Ethereum rather than horizontally across multiple blockchains. So it's a bit of a race right now to see who's going to build the right platform that more and more users are going to be able to adopt. Obviously, there's a lot of excitement right now around Solana in particular. It feels like it's gaining a lot of narrative momentum, but the adoption metrics aren't really there yet, and the application space is not super mature yet. There are only really a couple of things on Solana that are really working and have any actual usage. So it feels still early, and there's a lot of game to be played. So we're paying close attention and trying to figure out where we should be placing our bets.
And what about the side chains? Because when you're saying like we put in Polygon in the same bucket as layer one, different layer one solution, I don't know, maybe I misunderstand something, but I don't know if it's 100% we can do that, right? Because some of the components that they're building right now are definitely going to be considered as layer one, but some of them are layer sidechain. There are a lot, and I've heard some people who are skeptical about what's going to happen in the future. Right now, it's definitely a needed solution, and they're practically making it cheaper to transact on the Ethereum.
Right.
But I want to hear your critical analysis of what do you think was going to happen, even in 1 year. Let's not even talk about 2 or 3 years.
Yeah, 1 year is hard enough to project. If you look at Polygon today, Polygon, for those who are not familiar, it's a Ethereum sidechain, quote unquote, thing that technically they call it a commit chain. It's a proof of stake blockchain that bridges to Ethereum and is much, much faster, but is a fork of the EVM with a separate consensus layer kind of plugged into it. So Polygon, it's not, it is a sidechain in a sense, in the loosest term, form of the word sidechain. In the traditional sense of the word sidechain, it's not really a sidechain. They call it a commit chain, which means that bridging into Polygon is sort of a one-way thing. And coming out of Polygon, there's basically a multi-sig wallet that handles the bridge. And then the state of Polygon gets committed to Ethereum every once in a while as a commitment, but it's not actually being validated on Ethereum because that would be far, far too expensive. So that's the way Polygon works today. Now, Polygon, the team behind Polygon, they want to create a suite of interoperability products like layer twos and rollups and other things that will connect back to Ethereum. But today, the primary product that's working is the Polygon network, which is this quote unquote commit chain / sidechain / whatever it is you want to call it. Now, what's going to happen a year from now? That's a very difficult to answer question, but I'll take a whack at it. So one is that it's very clear that the dominant thing that's working today is EVM-based chains that bridge back to Ethereum. So you see Binance Smart Chain and Polygon being the two largest examples thereof. There are a few other chains that are starting to get some traction, like Avalanche. Near is about to launch its Aurora chain. There are a few other smaller ones like Phantom and whatnot. But for the most part, almost all of the adoption is on three chains: Ethereum, Binance Smart Chain, and Polygon. So I suspect that what we're going to see is, one, that probably the EVM ends up winning. The EVM is the virtual machine that runs on Ethereum that Binance Smart Chain and Matic basically just copied, or Polygon basically just copied. You can almost think about this as like, the operating system. The operating system for Ethereum is EVM. It's like Windows, and it seems more and more like basically Windows 1. It's over. There are a lot of people who propose a lot of different virtual machines that might be better, are more economically designed, they're faster, they're more efficient. But when it comes to just all the tooling and the network effect that's been built on top of the EVM, it seems like we're getting a lot of evidence that network effect is so big that it's too difficult to overcome. And overwhelmingly, if something's going to get adoption, it's going to get adoption because it adopts the EVM.
Yeah.
If that's the case, if we're right about that, then I would suspect that even if we are going to see these other layer ones become successful, it's going to be because they build an EVM shim on top of their native virtual machine that allows the EVM to run with very, very high efficiency on their own native blockchain. Mm-hmm. In a way akin to what's going on with Matic / Polygon. So that would be my first prediction for what happens in a year. The second thing, of course, is we're seeing this proliferation of rollups. Rollups are, how can I summarize rollups very briefly? Basically, a rollup is a layer 2 technology, kind of like Lightning Network on Bitcoin, but it's for smart contracts on Ethereum. That's what a rollup is in a nutshell. It gives you the security of Ethereum without having to build directly on Ethereum, and therefore you can have lower fees. So there are a number of layer 2s that are being built and very close to getting widespread mainstream releases for them. The first two are Arbitrum and Optimism. They're both optimistic rollups, and then we have ZK Sync, which is launched by Matter Labs, and then Starkware. They're launching a ZK rollup called Starknet. So I suspect that what happens with the layer 2s is that maybe there's some adoption for them, but I don't think it's going to be widespread. I suspect that you're going to see some bifurcation where the low end of the market goes to the very, very cheap chains that are similar to the Binance Smart Chains, the Polygons, the Avalanches, and then you see the very high end of the market, which is just going to live on Ethereum. It's going to be on mainnet. It's going to be directly there. If you're transacting, if you're Justin Sun and you're moving around, $1 billion, $2 billion a pop, then you don't really care about paying, $20 fees. Who cares? Just not significant to me. Whereas if you are, if you're a small retail player, then $20 fees is maybe more than you're even transacting. So it's not economical for you to pay that kind of fee on, a $30 trade on QuickSwap or whatever. So in that universe, you see this bifurcation between these two sides of the market. And I suspect if that's what we see, then the roll-ups kind of live in this no man's land where they're not quite cheap enough for retail, but they don't have the liquidity that the whales need. And they never end up quite taking on a whole lot of adoption unless they can really have a distinct technological advantage. And that's one of the reasons why I'm excited about ZK rollups in particular. ZK rollups, like what Matter Labs is doing, they allow more hybrid solutions that allow you to get much, much higher throughput and do stuff that you couldn't otherwise do on Ethereum using the power of cryptography and zero-knowledge proofs. That's a little bit farther out. It's going to take more time for us to develop that technology. But if I had to guess a year from now where we're going to start seeing adoption, that's where I would guess the layer 2 direction is going to move in.
That's very interesting because There's another question that I'm going to ask you. So I have like a group of people who are now like super excited about blockchain. They recently like found out they're the developers, smart one. They're learning Solidity, and they keep on asking me, and I'm telling them I'm probably not the right person to ask them. So what can we develop? What can we do like as a simple step to get into? Like, we want to build something that is useful but not super complex, just to play around. What would you advise people who are just like dabbling into the, like into this entire crypto world, but they wanna test their ability to code, and and just to make sure, like I give all the context, right? They're very good developers. We're talking about like people who are like very good in JavaScript or Angular or like any other like like React, like so the front end, back end, or full stack. So they know how to code. They just like now learning Solidity. What would you advise them? Like, that's the next big thing, to play with rollups or to build like some other like small applications as a developer?
Yeah. Well, first I would say start small. Build something that you feel confident building and that is relatively encapsulated and easy to use. One of the simplest things I would say if you really want to build something is build a tool that can be used by an application that already exists, that can either analyze it, display it, visualize it, virtualize it. Those kinds of tools are always a very good way to kind of get your feet wet, where you're staying still in the Web 2 world in terms of building a traditional web experience, but you're ingesting information or data or visualizing data that's on the blockchain. Now that's not Solidity work. You don't need Solidity in order to do that. If you want to stay on the Solidity side and do more kind of back-endy work, then my recommendation would be see if you can't take something that has been implemented on Ethereum and fork it / port it to another EVM compatible blockchain. And that's a nice way to kind of build your understanding of how some of these DeFi protocols work, but also create an adjacent version. Like go to Avalanche and go create something that's like OpenSea. OpenSea in principle is not that complicated. There's a lot of design work and a lot of finishing touches, a lot of attention to detail that goes into making it great. But the very bare bones underlying thing, it's like, okay, it's eBay. So can you build like an eBay on top of another blockchain? I think that's a great way to get started. Craft a niche for yourself, get some actual users, and that'll also build your intuitions for what it takes differently to be a great blockchain engineer as opposed to a great traditional web engineer. And if you get something out of it and you learn something, then I would eventually go on to building something totally novel, which is where, as an investor, that's where I always like to see people going, is building something, not just a migration of something that already exists, but something that's genuinely new and solving an unsolved problem.
No, I think it's a very good advice. So I'll definitely also send them this. So the other question we're talking about on your investment side. So there's a trend that is happening right now because there is adoption, as you mentioned, Avalanche, Solana, like some other like people are starting to build Cardano and other like protocols. So there are almost like this problem of copycat, like NFT platforms like almost look the same, and we're talking about interoperability, composability, but the projects are like they're just in different chains. So as an investor, how do you even do diligence, like, two very similar products, but on different chains?
The answer is that, so if you're underwriting a fork, literally you're forking a product that already exists and you're investing into it on another platform, that's fine. It's, we're not opposed to investing in a fork per se. Generally, we prefer investing in things that are totally novel, that are, again, creating new uncharted territory. But if you think about it, it's very similar to, something like what Rocket Internet does, right? Where you basically take, you look at something that's working in the first world or something that's working in America. So you say, oh, okay, I see that Uber really works. It's a business model that makes sense. Great, we're gonna take Uber and we're gonna go launch it in Indonesia, or we're gonna go launch it in Brazil, or we're gonna take this concept and we're gonna internationalize it. And that works. It works very consistently as a strategy. If you have a country that has a developing economy and a big middle class, they're going to use the same kinds of things that people in the US like to use. The same thing is true in crypto, right? If you have another platform that's really working, if you have a AMM on Ethereum and people love AMMs, you go build the equivalent thing on Polygon and people are going to want it. And that's what QuickSwap is. Or you do the same thing on Binance Smart Chain, that's PancakeSwap. So I suspect that this model is going to continue working if you have multiple disparate ecosystems. There's going to be very similar players who play the same roles in each market. Just as there's OpenSea on Ethereum, there's the equivalent on Binance Smart Chain as well. The question is, who's going to build it, and how are they going to differentiate to make this product specifically catered to this particular market, right? So in the same way, look, if you go build Uber in Indonesia, it's all well and good to say, okay, a lot of the server, the backend, and the routing algorithms are going to be similar, but what do we have to do differently in order to capture this market and then to do a great go-to-market in this country? In order to do that, you need a great team, great founders, and great insight into what's different about this market relative to any other one. Yeah. And that's the way that we think about people who are doing forks or similar products on different blockchains.
Yeah, totally makes sense. So there another, I want to ask you, this common trend in crypto that some teams are anonymous. Would you invest in an anonymous team?
We have invested in anonymous teams.
And why? How would you explain to your LPs that you don't you're the founders of your project, they cannot disclose their identity?
It's very simple. Is that if you guys have an investment in crypto, you've also invested in a pseudonymous founder named Satoshi Nakamoto. So there is a very long tradition in the crypto industry, literally going back to the very beginning, of pseudonymous founders. And the difference that I would point out is that, first of all, pseudonymous founder does not mean anonymous founder. Mm-hmm. If you are anonymous, that means that you have no reputation. There's nothing for anyone to go after. It means that there's no stability in principle of knowing whether or not this person is going to stick around. If they're pseudonymous, there are many pseudonyms in crypto that have built up reputation, that have shown a great track record, that have accomplished things that are even greater than some people who have known identities have accomplished. By definition, the guy who built our entire industry, guy or gal or people, was pseudonymous in the first place. So if you're not willing to back a pseudonymous founder, then to my mind, you don't belong in this industry. You shouldn't be underwriting Bitcoin if you don't believe that pseudonymous founders can build great products.
I think it's a great answer. Because I from traditional investors, I get a lot of criticism for that. So now I can show this answer, and then this is going to be my.
I don't know. I don't know if it's going to be satisfying to every investor, but the honest answer as well, of course, is we're not chucking half the fund into one product created by some pseudonymous person. With any set of founders, you always want to be diversifying risk. That's why we're a vendor portfolio and not just a SPAC. So for that reason, I think even if and there have been times when there have been less than savory characters in crypto, but actually very seldom have I seen that happen from pseudonymous founders. It's actually almost always the ones who have no names that end up doing the most egregious things in the space.
I've seen both, but I would agree the percentage of the known people, that's probably higher. So another question, so about the tokenomics, I think what we've seen some crashes of big project with Mark even that happened recently with Titan, that's because of the flaw in tokenomics, the entire project can be jeopardized. Now, to analyze the tokenomics, you need to have a very, very good financial background, and not only financial, you need to understand crypto deeply, and understand financial engineering on a very high level. So how would you advise to structure the tokenomics and run it through maybe several people before even showing it to an investor and make it into the community?
If you're a founder, you mean?
Yes, if you're a founder,
No. So that is an extremely difficult question to answer in a generalized way. It's sort of like asking, if you're pitching a traditional company, you might ask, how would you advise structuring your business model before you pitch an investor? And the answer is, that's the whole way. The answer is everything about business models. For token economics, you don't need to have all the answers by the time that you pitch an investor, but you do need to have. In a way, token economics are the easiest thing to fix when you're actually talking to an investor, assuming that the product itself is not live, because there's a relatively limited universe of token economic models that work. And as an investor, I know pretty much all of them, and I can help walk you through them and pattern match and figure out what would be the best fit for the thing that you're building. Mm-hmm. And so in a way, I would almost say, I'm not that worried about founders coming to me with brilliant token economic models. What I really want them to do is to come to me with a great fundamental idea. The token economic model is almost like the way that you align incentives. It's like the way that you figure out your referral program or your marketing program or your compensation program or whatever. These are details that we can figure out together once you have a great fundamental idea. But first, have a great fundamental idea. Once you have that, once you're actually solving an unsolved problem in crypto, the token economics can help pour fuel on the fire. It can help accelerate the thing that you're trying to fundamentally accomplish. But the core insight is the thing that you as a founder need to arrive at first before you start worrying about token economics.
Makes sense. Have you seen situations where it can be fixed even after the raise when it's almost?
Yes, absolutely. I mean, it happens all the time. Like there are many projects in crypto that have radically changed their token model, realizing what their eventual go-to-market ought to be. So, 0x is one of the most famous examples of this.
Yeah.
There are even layer ones that have dramatically changed their token model, like Ethereum, which is about to change its token model with EIP 1559, and then change it even more dramatically once they move to proof of stake. So there's absolutely nothing that says that once you launch a protocol, that it is not okay for you to go then and change your token economic model after the fact.
Okay, so not for the founders not to be worried, because that's one of the pressing questions I get all the time. So good. And so maybe there are several stories lately that struck you, and maybe we can talk about like some of them, because I know we had this like preliminary discussion about one of them, with Flashbot drama, right? And so I want to hear your opinion on this, right? And maybe
yes, I can speak to it very briefly. So Flashbots, for those who are not familiar, Flashbots is an organization that basically helps to, I'm guessing actually I should probably define the term MEV. Yeah.
Yeah.
I'm assuming. Okay. So let me start with the term MEV, because without understanding MEV, you can't really understand what Flashbots is. MEV stands for miner extractable value. MEV is basically this concept that if you are a miner, you basically control how the block in Ethereum, every single block that's mined on Ethereum, how it's formed. So the transactions that are inside of it, the ordering of those transactions, that is completely in your control if you're a miner. So there's this concept in Ethereum of what's called miner extractable value, meaning that if you've mined a block, in what way can you profit from being able to organize the contents of that block in the way that you choose? So you can imagine if you have an exchange and the guy who's running the exchange basically can decide in what order transactions get executed on the exchange, you'd be like, holy shit, that guy can really fuck me if he wants to. Well, that's exactly what's going on in Ethereum today. The miners are that guy running the exchange, and they can decide how anything runs. They can insert transactions, they can reorder transactions, and they can and do get up to shenanigans on Ethereum using that power that they have. So this is known in Ethereum as the MEV crisis, which is how can you create a stable DeFi ecosystem when you have these fairly rogue and self-interested people, miners, controlling the contents of all the blocks. So Flashbots is one of these organizations that has been developed to mitigate some of the externalities that's caused by this MEV crisis, by the fact that miners, who are these random people who really don't have necessarily the stewardship of Ethereum in their hearts and souls, they're the ones in charge of deciding Ethereum blocks. How can you mitigate the downside of having these guys in control and keep everything as fair as possible? So okay, that's where Flashbots is. That's what MEV is. Now, what happened last week? So there was this story where Flashbots is in the role of trying to control this marketplace for MEV. Well, this other guy came up with this idea: what if you created a marketplace where anybody could put a bounty on doing a block reorg? Mm-hmm. Now, what is a block reorg? Okay, so now we're zooming out a bit again to talk about how blockchains work. So normally in Ethereum, blocks are mined one block at a time. So someone mines block A and someone else mines block B that's built on top of block A. Someone else mines block C on top of block B. So now in principle, what can happen is that someone mines block A, someone mines block B, and then someone else says, hey, I don't want to build on block B. Instead, I'm going to go and rebuild on block A again, but instead of this guy winning block B, I want to win block B instead. Now, why would you care about this? Who cares whether you want block B or block C, right? Normally, if you're behaving honestly, you're supposed to just follow the longest chain. That's the rule that we've all been told in grade school, that's the way the blockchains work. But if in a world where there's a lot of MEV, let's say, for example, you and I are trading on an exchange and there's a big there's a big arbitrage trade that pops up. Let's pretend, for the sake of argument, there's $1 million that can be arbitraged in this one block. Okay, that's really weird, but occasionally it happens on Ethereum. Like on the day that the Ethereum, on the day that crypto got chopped like in half, there were a ton of momentary arbs like that popped up on many exchanges, and whoever controlled that block could capture the entire arb. So it's like $1 million in free money. Now, if there's $1 million of free money sitting in this block that anybody can go in and take, well, the miner, if you're the miner, you can just say, you know what, instead of this guy in the blockchain winning this arb, I'm going to just delete his transaction and insert my own. And I'm going to say I won that arb and I won $1 million. Now, if you do this, okay, so one block passes, two block passes, someone goes back and says, hey, wait, these two blocks are worth like maybe a couple $1,000s. That's no big deal. I want the $1 million that was 3 blocks back. They're incentivized to go back and instead remine that old block and try to win it for themselves. And you get this pile on of a bunch of people trying to win this old block. This guy created basically a marketplace where anybody can put up bounties for miners to go back and remine old blocks for precisely this reason. And of course, if this happened and this were institutionalized, this would create a lot of instability in Ethereum. Now, suddenly you would not be confident at all that Ethereum would keep moving forward, but that instead Ethereum might fork and go back several blocks and the blockchain might change because somebody put up a bounty on getting it to change. So this is scary. In the absence of anything else, you think like, oh shit, does this break Ethereum? Well, what happened was there was a huge immune response from the Ethereum community. Everybody was like, what? How could you do this? This is terrible. This is going to break Ethereum. The guy ended up getting bombarded. He ended up, making the repository private on GitHub, taking it down. He apologized. He sort of, it was a big whole, drama that took place on Ethereum. And the aftermath of the drama, which in some way you could look at that and say, wow, it really took a lot of social coordination to stop this thing from happening. It seems like Ethereum was really close to the brink of this horrible marketplace popping up. That's one way you could read what happened. The way that I read what happened, which I think is closer to the right reading, is that in the end, it's compelling to claim that blockchains are governed purely by crypto economic incentives, purely by computer science and cryptography and mechanism design. But in fact, that's not true. There has always been a component of blockchain design that's socially enforced. It goes back to economic research by Elinor Ostrom talking about the governance of the commons. There are many different ways where blockchains are actually not incentive compatible. Many different ways where in actuality, if it was just actually a free-for-all, then blockchains would not work. For example, mining pools. Famously, there are no mining pools that have more than 50% of the hash rate. Why? Why is that true? I ask you, Konstantin, why do you think there are no mining pools that have more than 50% of the hash rate?
I think it's just because there is a problem of 51%, control.
No, exactly. We don't want that.
Yeah.
That's the reason why we really, really care whether or not there are 51%, any mining pools that have 51% hash rate. But if you're a mining pool, what do you care what people say? What does it matter to you what people on Twitter yell about or get upset about, right? If anything, it's in your interest to have more than 50% of the hash rate. Actually, it makes you more profitable. Turns out there are all these subtle ways in which your profitability goes up the more of the hash rate you have. But it has never happened. Doesn't happen in Bitcoin, doesn't happen in Ethereum. Why not? The answer why is not because of crypto economics. It's not because Satoshi designed some beautiful, elegant protocol that magically solves this problem for us. Exactly the opposite. Actually, everything about mining incentivizes centralization. The more and more hash rate you have, the more profitable you are, the more economy of scale that you have. If anything,
yeah,
exactly. The way that we solve this problem, the way that we prevent mining from being too centralized is through social enforcement. It's through the governance of the commons. It's through us as individuals, you and I and everybody on Twitter, coming together and agreeing that we're going to yell and smack pots and pans together and make a big ruckus anytime someone breaks this norm. And it works. It works. There are no mining pools that have more than 50% of the hash rate because of this socially agreed enforcement. You and I and our social agreement has papered over the weakness of Nakamoto consensus. We, through our social consensus, fix the weakness of the crypto economic design. And this kind of thing, once you recognize this, you start to realize that it's all over the place. many, many different places in crypto. The weaknesses in security are fixed through social consensus. And this is not a bug, but a feature of the way that blockchains work. Blockchains need healthy communities and institutions that are enforced by individuals to be secure. And I think this is another example of that general principle.
I think it's beautifully put, like the way you analyze it. And I think what's happening to China, the exodus of miners from China, it's actually beneficial because exactly what you're saying. Now, where are they going to go? They're probably going to go to more developing countries where you will have to build like powerful social communities, like who will govern it in hopefully in the right way, right? And there will be no like this ability to have this consolidation of a lot of power and a lot of pressure and even a hypothetical ability to control like huge pool. So yeah, that's a very interesting analysis. And by the way, if I may ask you, what do you think was going to happen to Bitcoin and Ethereum ratio, right? That's another like if you're gonna really quickly like, so there are a lot of analysis I see like from Rollups and some other like folks who are like very vocal about it, right? That there will be very soon, like in the coming years, not like they're not talking about months but years, like then when it's basically gonna equalize the price because the proof of stake is like the future. And then they get a lot of like criticism of Bitcoiners, like who are like hardcore, and they're like, "No, you're crazy. This is not going to happen." So I want to hear your stance on this.
You're not going to get a lot of fireworks out of me on this. Short answer is I don't know, and I think it's it's not the kind of thing that I think I'm equipped to be able to forecast. It's possible that Ethereum flips Bitcoin. It's possible that Bitcoin always ends up being top dog. I don't think this is one of those things that's predetermined. I think it's very, very path dependent. And it depends a lot on basically the way that institutions treat these different asset classes. So if institutions are basically like, look, Bitcoin is the oldest, most trustworthy, I'm going to see Bitcoin to be the kind of digital store of value, then that's good. That's going to be the way it plays out. If instead this ESG narrative becomes increasingly dominant and Ethereum becomes the beneficiary of that because it's going to be the first major blockchain that is purely proof of stake and still has the longevity and the pedigree that a Bitcoin, closest in neighborhood toward what Bitcoin has, then it's possible that Ethereum ends up replacing Bitcoin and becoming that, that store of value asset that is more palatable for institutions to end up getting putting their weight behind. I don't know. In principle, it could go either way.
Okay, that was my attempt to get some viral content from you, but okay.
Unfortunately, it came up dry. Sorry.
No, it's fine. I agree with you. They have to be very careful. I also don't predict those things. I'm just curious. Maybe you see some of the patterns which people don't see. But yeah, we'll definitely see how the institutions drive the driving force. That's 100%. And we see a lot of companies that are put into treasuries, Bitcoin. Still, there are much more than companies that are putting Ethereum in their treasuries. That just a fact that you can
absolutely
look up for yourself, right? So as long as this is happening, I also do believe that Bitcoin will remain a digital gold, and others like an Ethereum will just follow, right? But then,
well, the one thing to remember though, and this is the point I'll put in favor of Ethereum, is that right now Ethereum has been around for about 6 years. Yep. Bitcoin has been around for about 11 years, and that is a big difference. Bitcoin has been around twice as long as Ethereum has been around. 10 years from now, the ratio is not going to be 1 to 2. The ratio is going to be, it's going to be 1 to 4, basically. Sorry, 3 to 4. Is that Ethereum will have been around 16 years and Bitcoin will have been around 21 years. At which point, it kind of looks like a wash.
Yeah,
right? Like you stop really caring which one came around first.
Exactly.
They've both been around for a very long time. So I think that difference is going to shrink with history, and the meaningful differences that are going to magnify are going to be the substantive differences about how the two assets are perceived to be different in their form and their substance.
I agree, 100%. So that's why the narrative about the green energy and other we're mining that's also going to define a lot. I would say.
Right.
So let's because you want to wrap up already soon. So I want to ask you two more of a personal questions. One is what would be a book that you would advise people who are into this crypto / metaverse more educational journey
to what will be the one book you advise, and then I'm going to ask you the second one. Yes.
The one book. There is so two different answers to that question I would give. One is that I don't think if you want to really learn about crypto, that you're going to learn it through books. Like there are a lot of things that are best learned through books. Very clearly, I think the best way to learn crypto is through primary sources. And the primary sources in crypto are overwhelmingly blogs. So if you want to learn about crypto, go read the blogs of the people you admire. A great place to start is just go back through everything that Vitalik has written. That, to me, should be the kind of first chapter of crypto education. Is if you go back to the very, very beginning days, back when he was writing for Bitcoin Magazine, and kind of work your way forward to the history of Ethereum, Slasher, initial thoughts on proof of stake, zero knowledge proofs, blah, 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 going all the way to present day, that's going to give you a great education and what is going on in crypto and what are the values of the crypto ecosystem. If you want to go more specific and you really insist on a book, there's one book that I'd recommend very highly. It's written by, I think his name is Bruce Campbell. That's on DeFi. I can't remember the name. I think it's like DeFi, The Essentials or something like that. It's a good way to get a broad introduction to Ethereum and the Ethereum ecosystem and DeFi and what's going on there. So that'd be one a book that I would recommend. But generally speaking, it's hard to say that books are the right way to ingest a lot of what's going on in crypto.
No, I would agree. Like I follow myself a lot of like podcasts and YouTube channels. That's how we perceive information right now in the 21st century. So the reason why I had a book, I just want to encourage people to read a little bit. Like, it's just we don't
definitely read. But I don't know if books are the form factor you're going to find it.
Yes. And
print out articles and blog posts. That's a good way to read.
Yeah. Or use Kindle or whatever.
Or send a Kindle. That also works.
I know you're also big in, like you mentioned, though, your major is philosophy, right, and technology. So, like, I want to ask you this question that is like, the name of my show is like holistic investment. So I have to ask you, what's the meaning of life to you, like, and why you do what you do?
The meaning of life. So that is a classically stumping question. I don't believe that there is any one meaning of life. I think that human beings define their own reason to live and they stick by them, but it's a subjective thing. It's not an intersubjective thing. So for me, the meaning that I've established to why I do what I do, it differs for different things. I wouldn't say there's one meaning to life, but the meaning, at least to me, for what I do within crypto, one is that so I donate a portion of everything that I make in crypto in my career, not just in crypto.
Yeah.
So a third of my pre-tax income, I donate to high impact charities every year. To me, that's a big part of what motivates me to keep, putting all my energy into what I'm doing and trying to have a larger impact than what I can have directly through my own career.
Can we advertise, by the way, Founders Pledge? Like, I just want to.
Yeah, absolutely. Founders Pledge is a great organization that if you're a founder or an investor and you are thinking about ways that you can give back and have more impact through your own career, I'd strongly recommend you get in touch with Founders Pledge. They're a great organization. A bunch of great people who've built really amazing companies have taken the Founders Pledge, including folks like I believe the founders of Instagram, founder of Asana and Facebook and stuff like that. They're a part of the organization. So definitely get in touch with Founders Pledge if you're interested in learning more. Then the other side, of course, is that on the object level, which is what I'm doing with my career, I love getting involved in this industry and having some, even if it's a small way, which it certainly is a small way, that I can have a voice and impact in some way the shape of how this industry evolves. That is, for me, tremendously gratifying and just honestly really fun to be involved in a fledgling industry like this one.
Yeah, so you just love what you do. That's already like a lot. So that's what gives you, that's the source of your happiness, right?
Pretty much. I don't know lately if I call it happiness, but it's certainly the source of my motivation.
Well, listen, struggling is also part of the process, right? You have to.
That is right.
You have to enjoy it as well. Otherwise, there will be no true happiness. We'll get bored very easily, right?
Oh, that's right. As Nietzsche says, the commandment is to love your fate.
Exactly. So listen, I really enjoyed it. And I think like you're one of those people that I think if we would talk like for hours, there would be always like content and always like, interesting topics, and you're such a versatile intellectual. That's what I like about you. So I really appreciate what you do to the industry. Like, you invest, you show a great example, like with your involvement with charities, your involvement with just helping founders to find a way. And the way you shape your investment thesis, that you're like, just come to us if you have a great idea, we're going to help you. Like, we're not like those cocky venture capitalists. Like, we're just like, so this is I think people would appreciate that, like, so that you have this amazing human being part in you, like not just like, Silicon Valley executive, like, so, and I really wish you luck in finding more great companies. You're already successful. You've invested in great companies, and I want to see more crypto unicorns coming out of like Dragonfly Capital.
Thank you, Konstantin. That means a lot coming from you. Thank you for the kind words, and I really appreciate you having me on. This was a really fun conversation.
Yeah, really. Thank you so much.